Welcome, everyone, to our quarterly update and economic review with IntentGen Financial Partners. Typically, when Pat and I go through these presentations, we are going historically a look back at the quarter, but given what we saw in April, we thought it would be relevant to spend a little bit of extra time going through the initial tariffs, some of the updates, and then where we're at now. So I'm Jacob Schatz. I'm a partner at the firm, and I am joined here as well with Pat Morris, our investment manager. Pat, how are you doing today?
I'm doing good, Jacob. Thanks. It's been a crazy 5 months to begin for sure.
Absolutely, and we'll give you little doses of that, and hope to have some relevant content for you. So let's go back all the way to April. Which seems like forever ago. But the initial tariff day was a 10% universal tariff on all imported goods. There was additional tariffs that were applied on countries currently running a trade deficit with the U.S. Canada and Mexico were excluded just in the discussions of reworking the USMCA. There were also sector exemptions, which included energy, steel, autos, pharmaceuticals, and then there were additional ones, notably China, that had additional tariffs imposed on them. Subsequently, we did see China apply retaliatory tariffs. It was rumored at the time there would be potentially some negotiations, but certainly that the administration wanted to be involved in each one of those negotiations. And a lot of lack of clarity around the policy at this point because we just didn't have clarity on, especially with the sectors, semiconductors were exempted. But yet when we think about those chips within the servers, are servers going to be exempted as well, or is it just semiconductors? So still just a lot of muck to try to clarify on what would potentially be taxed versus what would not. And what we saw then was the highest tariff levels since the 1870s, the largest tax increase since 1968, and the potential revenue from the tariff was approximately equivalent to all of U.S. corporate tax collections last year. So we're dealing with a significant thing that came up then. Now, after that, then about a week later, we saw that things were still shifting, but a 90-day tariff relief was applied, further reducing tariff rates to a baseline of 10%. Countries that had not retaliated, mostly again, China, were not part of that relief. So that's still at about 120%. Canada and Mexico, again, remain exempt. But even during that 90-day window, the actual impact, because of China's 120%, was still almost the same as before. But I think it's important too. Pat and I were looking at this earlier. Just like 120% seems like a significant number, and I want to definitely agree that it is, and so is the original 145% that was put out there. But anytime we start to see the numbers get elevated above that like 60, 70-ish% range, the actual impact above and beyond that starts to diminish. And it's just because at that lower range or that mid range, that's where we start to see consumers shift their purchasing. They might go buy an alternative, they might delay, they might substitute, which again is something that you'll see once you start to hit that resistant level. So 145, 120, still significant, but just being practical that they are definitely applicable numbers when it comes to what consumers are doing anytime it's above 60 to 70%. So if you all recall, you've certainly got your April statements, but if for those clients that were checking on a day-to-day basis, we saw markets react quite significantly in a couple-day time frame. And so Pat's going to go through some of the returns just that we saw across the market at that point.
Great. Thanks, Jacob. Yeah, I'm gonna run through two charts here. The first one, this is through April 9th. So this is basically the day after the tariff relief, or excuse me, the market close of the tariff relief day. So as you can see, we saw some right before that, some drastic drop-off numbers. I mean, the Russell 2000 was down was down more than 20%. And the S&P was down. Even the foreign markets, which had done fairly well, had kind of fallen into negative territory. But that last day we saw some great returns, and we'll touch on those later and kind of what of a historic day it was. But then fast forward almost 2 months, and here's where we're at now. Still the Russell 2000 coming back, but still struggling a little bit, down 7% for the year. But the foreign markets have done well. And the S&P 500 has eked out a positive gain so far for the year. The other couple things I want to point out here. One is, bonds acting like bonds. As you see there in the middle, the Bloomberg aggregate, 2.4% for 5 months, kind of being a buffer to the volatility around stocks. And that 2.4% is, bonds did not have a great April and May, but have still done fairly well for the year. And the other thing I want to point out, well, two more things. One is obviously the volatility. You look and you see, numbers that were -5% are now 17%. Numbers that were -20 are now -7. There's a lot of volatility in the market. Actually, after we've seen 2 years of, kind of very positive returns and not a lot of volatility. So, and the other thing is this diversification, right? So not all your eggs in one basket. A portfolio built with foreign and domestic stocks and with bonds presented a nice portfolio at this point.
And I'll just add a comment too. Sorry, Pat, to interrupt
Sure.
you, because it's just an important update now because, we did see negotiations go across a number of countries, specifically with China. And so it seems like at this point, there's a little bit more clarity on what the potential tariffs will be between the two countries. And that, I think, is a big catalyst for eliminating some of that uncertainty and driving some of the market performance here in the short term. Again, we still have a lot of federal legislation to get through. We've got global conversations. If these deals can always go backwards, but it seems like a little bit of a reprieve has led to markets performing the way that they have.
Yeah, definitely. The markets always, the one thing markets always want is clarity or certainty. So great point. And so, but one of the questions when what Jacob was talking was like, well, what does this mean? What do the tariffs mean for the economy, right? So what we think we're going to see is a jump and then a fade. And what do I mean by a jump and a fade? Well, you heard when the tariffs first came out, we'll take cars as an example. We heard $6,000, $8,000, $12,000 tariffs on cars. So people who are like, well, I'm going to buy a car in August or September are saying, well, I'm going to go buy that car now before the tariffs came out, right? And if the tariffs were enacted or are enacted, you're going to see a jump up in pricing because that's inflationary. It's the numbers are going to go up. But then, you stop there and think for a minute and you say, well, what's going to happen when these tariffs go in? Well, one of three things, right? Number one, they're going to get passed along to the consumer. Or number two, the business owner himself says, I can't pass along to the consumer. I'm going to have to eat it. And they're going to, therefore, profits will be down, or it's going to be a combination of two. So basically, this will eventually lead to what we think will be negative growth. And this chart here shows it that now I can't, speak to the pinpoint of the accuracy, but the direction is generally is right. And why is that? Well, because inflation is a demand side variable. So basically what's going to happen is if you have inflation, what's going to lead to less price or more uncertainty in the market. It's going to lead to lower profits as people, eat some of those tariffs. They probably won't hire as many workers. You won't have as many workers. Demand will eventually drop because there's less demand for the product. So we basically think inflation is demand, or demand and inflation are negative growth incidents, so to speak. So, and we can see that kind of in the numbers. So the economy always, economic data always lags the market. We've always said that. And here is kind of the truth. These are real numbers that the Fed uses, the 5-year break-even and 10-year break-even rate. And you can see they're kind of at the bottom that they start kind of, towards at the beginning of April, they were starting to come down further and further. So more reasons why we think that, if the tariffs are impacted, that, you're going to see some negative growth. So, there's always been a contrast or, at odds between fiscal policy and monetary policy. And this administration is probably no different. So, monetary policy is basically worried about two things: inflation and employment. Fiscal policy is more about tariffs. We're looking at tax creation, and even then, 20% of the GDP is the government jobs, and if we're shrinking the government job force, that is a restrictive federal fiscal policy. Monetary policy is also restrictive. The administration would like a more relaxed, a more open-ended policy as terms of monetary, but for their purpose, the Fed is sticking to their guns. And we kind of see this in the probability for the December 25 Fed meeting. Beginning of the year, things were going pretty good. Inflation was a little sticky, but employment was okay. Talks of the tariffs come out, starting in more uncertainty. And you see, we focused from basically, we went from looking at 2 Fed cuts for the year to more to 3 to 4 Fed cuts for the year. Now, this is something that that is brought about by the Chicago Mercantile Exchange, the Fed, and it's a probability of what they think the rates will be at by the December 2025 meeting. This has shifted back a little bit towards the beginning of the year. They were kind of looking at the probability is now for 2 to 3 rate cuts, but still it's uncertainty. And basically what the market is telling us is that if the tariffs get enacted, that the inflation, while at first would jump, it would probably come down lower, and the Fed might be more interested in cutting rates. And we saw this in other economic data leading up to the announcements. U.S. consumer confidence was starting to head down, and the new orders, less inventory was was coming in. And some of this is just cyclical, right? I mean, we've had 2 good years of economic or market returns, so there's always some kind of cyclical component to it. And speaking of the market, so what does this all mean for earnings? Because that's basically at the end of the day, right? Is we're paying for earnings, and what happens is when there's an uncertainty in the market, there's 2 components to our PE, right, or our what we pay for stocks. The first is earnings, and as you can see here, the earnings rate has or the earnings of the S&P 500, basically just what each company makes in the S&P 500 times their weight in the S&P 500, and that will give us our earnings. And then there's a multiple that we apply to that, and the multiple is based on what the market is willing to pay for those earnings. That means they want something that has growth, something that has uniqueness, and something that has, we'll say, certainty. And when those 3 things are jeopardized, you see people pay less for a multiple. So what does this mean in basic terms is if you took an average market multiple and applied it to the current EPS, we could be looking at about a 10% downside market. And some of that we saw earlier in the year, and it has come back. Because the caveat is, these EPS numbers, while changing, can change back up towards positive. And, the market multiple that the S&P 500 has had for the past 2 years has been above average. So that point is, while they're negative 10% is obviously not written in stone, it's something to focus on what the downside could be. But in fairness, you have to focus on, all this volatility often is profitable. If you can get through the muck, so to speak, it can be profitable. And what we did, we worked with our research partners at Fiducian, and came up with, these are drawdowns that are larger than 15% since 1987. And there's some times in there, Black Monday, you're looking at the tech bubble, financial crisis, and COVID. And we looked and said, what happens if you were to just, buy after these things happened? And there's pretty positive results, right? We don't know where we're at in the middle of this cycle, but usually out of volatility comes profitable times. So when we talked about earlier, we showed that chart where we got that jump up on April 9th. It was a historic day for many reasons, but one, it was the third best return day since 1971. So, which was incredible. But a lot of times these big days happen in very volatile markets, and sometimes they're in downturn markets. So if you look the top 2 days there, October 13th and October 28th, those days happened in the middle of the great financial crisis. And so we didn't see the bottom of that one until March of 09. So, but the one thing that I thought was an amazing stat. So this is the third best day since 1971. There's been 14,000 trading days, and this is the third best. And what was the catalyst? An afternoon tweet. So, you can't make this stuff up. And it kind of drives home the fact that, you can't time markets. You don't know when you're going to be in. You don't know when it's going to be in. You don't know when it's going to be up, when it's going to be down. There's stats that show since 1988, if you were out of the market for the top 10 days, your return is reduced by 40%. So that's kind of another fact to drive home.
Thanks, Pat. And we just had this chart to overlay the returns of inflation and then the S&P 500 as well as bonds. So inflation is the yellow line, blue is bonds, and then the darker blue is stocks. And if we were to just look at any point in time, we see significant market headline events that cause a global impact. So Korean War, credit crunch, 1973 stock market crash, the Iranian revolution, Japanese stock bubble, Asian financial crisis, Euro debt, Brexit, the original tariffs back in 2017, COVID, which was significant. The point of showing this chart is that over time, we can't overreact in the single, month or week of an event just based off of a headline. And if we see this over time in the market is much more valuable than trying to time the market. And this just shows that there may not be another event specifically like the ones that we already see here, but something else will be on the horizon. This always happens, but those two shall pass. And it's important to really revisit, themes and why we're in portfolios the way that we are. So when we look back at the beginning of the year, it's hard to believe, right, that we're in June right now, but these were our themes when we released them back in January. So one is fragility, that, valuation concentration and inflation are going to be seeds for potential volatility. I think we can all agree we are in a very fragile, volatile period, even though we've got a little bit of reprieve for now, but it's still very fragile. Durability. So Pat went through some of those returns and talked about, not having all your eggs in one basket. And intentionality is really key with portfolio construction. And that's proving its way. When we look at returns of portfolios, they've held up really well relative to certain asset classes in the market because of that thoughtful dedication to asset allocation. And then number 3, age alpha, that's to be seen. We don't quite know yet, but active management and alternatives have potential to enhance portfolio resilience. I think especially when we look at globally, when we are looking at being dynamic with tariffs, certain sectors being hit, certain sectors maybe not being hit. We do want to activate a fund manager to be nimble in that space to hopefully exploit efficiencies and provide alpha in terms of the return over time. So those are the 3 themes that we looked back on, and just a good checkpoint of where we're at right now. I think the question though becomes for a lot of us is, so what? What do we do about this? What's the potential pathway forward? And what we wanted to look at was just 2 different stances. I'm going to let Pat give perspective on both, and then we'll give you just where our thoughts are on what's ahead. So Pat, why don't you hit we'll start negative first. If you want to go through what's a bear market, or what's the impact of a bear market from here on forward?
Sure. So, the bear impact here would be, the current levels that were originally negotiated go without renegotiation, right? And all the stuff that we've come back, we've seen some positive feedback that, you don't know, it could turn and we could be back where we started in the beginning of April. It turns out that it would be a mix of higher prices and lower profits. And basically, it leads to lower profits lead to less workers lead to less demand, and you find yourself basically in a recession. And now recessions happen. And you'll hear people say, well, this recession is different. And the truth is, every recession is different, but every recession is unique, but recessions themselves are not unique. We see one every 6.5 years. So nobody likes to talk about them. Nobody likes them, but they're kind of a fact of life. So that's what would happen in the bear market. And we just kind of fall, and then inflation would lead to lower profits would lead to lower workers, like we said, and then you kind of go into that cycle.
Great.
The bull part is, the tariffs start working, or the tariffs are negotiated. We come to better than expected agreements with foreign countries. And as the negotiations continue, the Fed sees a clear path and decides to reduce interest rates in new manufacturing at home, or US led businesses grow faster, and unemployment shrinks, maybe the deficit shrinks, and the greater efficiencies lead to more green on the screen, and we're off to the races. So
Awesome. So good perspective, right, of what could potentially happen if we see the bear side of things and the bull side of things. What's your, I guess, two questions here. So one is what's your stance of probability of what we end up seeing? And then second part is, well, why don't we hit number one first? What do you think might be a reality of what we see here?
sure, probably somewhere in the middle, right? And I think we've already seen the good and the bad of the negotiations, right? So I think it's good that we've seen that it wasn't that these tariffs were thrown out there and that nobody reacted to them. Seems like foreign governments are reacting to them, willing to sit down. I know that Britain has already negotiated something. There's also some hardlining back and forth. So I think you're going to see something in the middle, right? And it's not going to be smooth sailing for any means. And as we all know now, we were looking at that chart earlier that Jacob was talking, and in 1926 there weren't any tweets, or there was and there wasn't much headline risk, but there is now, right? So you don't know what comes out. Information comes out. Even, I mean, I won't say like just information on tweets about the tariffs, but like good news economic comes out, bad news comes out, it affects the market immediately. But I think you're probably looking at the base case scenario is somewhere in between.
Absolutely. Thanks, Pat, for sharing that perspective. And then the follow-up question here is, let's take those three paths: bear route, bull route, somewhere in between. Maybe you can even touch to what we did as an investment committee late April in terms of reviewing portfolios. But what may we potentially do? From a portfolio positioning standpoint, so this is going to be directly related to you as clients of the firm. But what will we potentially do with your investments, or what conversations we'll be having in each of these routes?
Yeah, well, that's a great question. Obviously, that's the end game, right? So what we do is we go through and we look at our capital market assumptions, right? So this is what's the market going to, what do we feel like each sector, or each category, large cap, small cap, mid cap, international bonds, emerging markets, how are they going to return over the next couple of years or next 10 years? And we kind of build our portfolios around that. So what we are always going to do is build a durable portfolio. But probably if the market were to fall, right, stocks at some point, like we looked at that chart before, stocks become more attractive. So we might look to shift more weight into stocks, and because the returns become that much more attractive. The bull case is what we have is working and we kind of stick with it. And then there's also the medium term one where we kind of like, hey, here's our numbers. We've kind of drifted off these a little bit. We'll rebalance where we see fit. But I think that in any case, what we're going to do is going to try to build durable portfolios that aren't all U.S. based or all aren't foreign based or bond based, depending on your risk level. And if your risk level has changed, then that's a conversation you should have with your advisor. But we're going to try to build portfolios that are relevant and durable to the risk level or risk tolerance.
Absolutely. Well, we really appreciate all the insight you have there, Pat, and we also, our friends at the firm listening in here today, we really appreciate your trust and confidence. And we will continue to do our job on our side of monitoring your investments, taking great care of them, and then also proactively reaching out, when there are times of volatility that creates opportunity. It could be purchasing times where we have money that we move from cash into the market. Maybe we do it all at once over time through limit orders. Perhaps we recognize some losses, we harvest some losses on portfolios. Maybe we look at doing Roth conversions. If there's certain stocks that have pulled back more than others, we can convert those into Roth IRA, and then let them grow tax deferred and give them the opportunity to recover. There's also gifting strategies that can be done throughout the year. And so if there are asset classes that have done well, we can give those directly to charity or through donor advised fund. Qualified charitable distributions. I think you get the point. There's a lot that we can do to be proactive in planning and creating opportunity. So reach out to any of us at the firm. We're always open to help out, and we look forward to connecting with you again soon. Thanks so much, everybody.
Thanks, everyone.